Yes.
Okay, hello everyone. I want to start with our Gatehouse side first. I have a presentation on Wednesday. This is a professor in our Gatehouse Analytics group and about advanced Excel techniques, just kind of hands-on and working through some things. I am of the view that irrespective of what AI does and doesn't do to any business profession, Excel will always be a vital component. Accountants and business people just use Excel. It's like a crutch. I use it throughout my career. I use it personally, and I think I'm pretty good at it. And I watch somebody who's really good at it, and I'm like, oh my God, I never knew it could do the things that it can do to manipulate and present data from a spreadsheet. So I'm sure much of that's going to be covered here, so I think it's well worth the time. Okay. So we are going to cover the last portion of the Chapter 4 material pretty quickly. And these are two topics, and they're across business entity types. So we're going to be talking about owner compensation and then business entity losses and the ability to utilize losses and what happens to the so when we say owner compensation, we are talking about the owner doing, working on behalf of the business entity or working, as an employee of the business entity. So not compensation from the standpoint of I'm the owner of the business and so I should be entitled to the rewards of the business doing well. That's separate. We're talking about compensation for the actual services that you are providing for the business. Okay, so because your owners can and oftentimes do work for the business, right? So you're wearing two hats. You're the owner, but you're also a valuable employee. So in the world of the C corporation, so a shareholder who works for the C corporation is not required to, but can receive compensation as an employee. Okay, meaning that they can be compensated just like an employee. So everything you've learned if you were in taxation of individuals, that's the employer-employee relationship. Same thing if the employee happens to be an owner. Okay. C corporations deduct their compensation, pay to a shareholder employee, and incur the employer's share of employment taxes, same as any other employee compensation. Okay. The shareholder employee is taxed on their compensation as ordinary income and incurs the employee's share of employment taxes, which is Social Security and Medicare, same as any other employee. There's no special status to them by virtue of being an owner as well as being an employee. Paid compensation that goes on their tax return, it's a deduction on the corporate tax return. The employment tax implications are exactly the same as any other employee. So I'm going to go through some planning opportunities here. And this is comparing the choice of business entity based on how you're going to compensate the employee, the employee if they happen to be an owner. Okay. So after the Tax Cuts and Jobs Act of 2017, corporate tax rates went from 35 to 21, as you know. C corporations may have an incentive to reduce shareholder employee compensation and increase income tax at the lower corporate tax rate instead of shifting some income to the employee's tax return that may be taxed at the individual rate of 37 at the highest level. Think of many of your business owners are high income individuals, and so if you're taking a deduction, you're removing it from a 21% tax rate because the corporation is taking a deduction, and it gets included at the marginal tax rate of the individual recipient, which might be 37. So the incentive would be, can I dial that back, leave more income to be taxed at 21, less taxed at 37, potentially. That would be the idea. Now, when we talk about this, it's all subject to transfer pricing in the bubble, meaning that I have to pay somebody representative of what the market is I can't let the tax result dictate not paying the compensation. So, for instance, if a business owner read this slide and said, oh, I see a planning opportunity here, that makes sense to me, I'm paying tax at 37% on my salary, walks into payroll and says, hey, put my salary at 0, I got other sources of income, right? That doesn't work if they are performing services that entitle that performance to income, to compensation. Okay, that's the role of transfer pricing. Okay, so there might be an incentive, but you can't let that dictate the result. You have to still compensate at an arm's length. Okay? So let's think about that in terms of sole proprietorships and how you compensate the employee. Owners of sole proprietorships do not receive compensation per se. The owner is the same as the business, right? If you remember taxation of individuals, that there's no compensation. There is no employer. It is you. Sole proprietor is the person. The business and the person are the same. So you don't pay yourself by paying right pocket to left pocket, right? So there is no compensation. You get the entire results. If you're a gig musician, guess what? You don't pay yourself a salary. You get whatever's left from the income and all the expenses to create that. That's yours. Okay? Partnerships. Partners who provide services to their partnership may receive compensation in the form of guaranteed payments. We're going to spend the last part of the semester on partnerships and S corps, and we'll cover this in detail. But many times partners work on behalf of the partnerships. Law partners work in the law firm. Accounting partners work for the accounting firm. You do get paid compensation. Okay, so partners deduct guaranteed payments for services in determining their net income. That then is distributed amongst the partners. And on the other side, the recipient partners of the guaranteed payment have that as ordinary income. So when I was a partner at PwC, I didn't wait to the end of the year to get paid. I had expenses just like anybody else, so I got paid once a month. And that was a, quote, guaranteed payment, which meant it was a deduction for the partnership in arriving at its income, and its income to me that goes onto my tax return. It's very much similar to the C Corp mechanic. Vastly different from the sole proprietorship. Okay. Planning opportunity here is partnerships may have an incentive to reduce guaranteed payments for services, which would correspondingly increase their business income. Why would you want to do that? The latter qualifies for a QBI deduction, qualified business income deduction. You get a 20% deduction if the business is qualified of your qualified business income. So if you leave more behind, the 20% is higher. If it goes out, it's not, the recipient doesn't get the deduction of qualified business income, only the flow-through income that's left after payments of payments.
So this is why like some people will have like partnerships or companies where like, yeah, they like technically hired by like other companies, but it's almost like a middleman, and then they can like get like income tax incentives on that. Like I know people who, I don't know, explain it. I think it's like a partnership almost, and they're like self-employed through that partnership, and then they kind of get contracted out to other companies, and like, is that why people do that? Because you can get the QBI deduction?
Well, interesting question.
I don't know if I worded that correctly.
So, but first of all, let me take it into bits. So if you're contracting out somebody and they're doing services on behalf of somebody, that's the transfer pricing part I mentioned. You have to get compensated for that to the fair value of what a third party would charge for doing a similar service.
Okay.
So that has to be that. But depending on how that income is received, if it's received into the partnership
Sure.
and stays in the partnership, and that partnership business is qualified,
Okay.
then the distribution of those earnings and the flow-through nature of it could be the 20% QBI deduction. So
Okay.
it could.
Okay.
It could.
Just depends if it meets those different.
It depends on if the income stays in the partnership.
Okay,
and
and what do you
flows
mean
out.
by that, like by staying in the partnership?
It's not paid out as
Okay.
a guaranteed payment.
Okay,
I think a guaranteed payment is a fancy word of saying salary.
sure.
That's effectively what I thought, quote, salary, even though I was a partner, so I was an owner and an employee working for them. Yes?
Could you have partners with like carry forward capital losses, use their capital gain, lower the tax?
So now you're talking in a different world because you're in the capital world, right? From the characterization standpoint, this is all ordinary income, okay? So it's really difficult to jump the bridge, if you will, and have capital offset ordinary income. If you recall from individuals, you can have 3,000 of your capital loss can offset your ordinary income every year. And this would be part of that ordinary income that could be offset by other capital loss that you might have in your year. Okay, S corporations. And a shareholder who works for an S corporation can receive compensation as an employee. This is very similar to C Corp. The S Corp deducts the compensation paid to the owner employee and incurs the employer's share of those employment taxes. The owner employee has tax on the compensation that they receive as ordinary income and incurs the employee's share of employment taxes. So very similar to the C Corp world. Okay. The planning opportunity, remember the distinction between an S Corp and a C Corp is S Corps are flow through. Business does not pay tax. C Corp, separate taxpayer, pays tax. So the planning opportunity, like partnerships, S corporations may have an incentive to decrease compensation to an owner, correspondingly increasing the business income at the entity level because the latter can qualify for that QBI deduction, just like a partnership. Right? So if you can, within the range of transfer pricing, dial down the amount we pay, leave it in the S corporation that then is distributed out as flow-through income at the end of the year. That might entail a larger amount being subject to the being available for the QBI deduction. If I pay it out, it's not available for the QBI deduction. Okay. QBI deductions do not apply to C corporations, only flow-through entities. Second planning opportunity, S corporations may also have an incentive to decrease compensation paid to an owner employee to increase business income because the latter is not subject to employment taxes. If I leave it in the business, it comes out as your business income. That is not self-employment taxes, Medicare and Social Security. If I pay it out as compensation, I have the normal employer-employee dichotomy on half each on the employment taxes. Okay, so maybe I dial it back for that reason as well. Again, subject to transfer pricing. You can just do this for the best tax answer. I have to pay within the realm of transfer pricing. Okay, here's an example of the transfer pricing. So just bear with me as I walk through this. So shareholders in S corporations have incentives to keep salaries low, so less income is subject to payroll taxes. Payroll taxes. People will say employment taxes and payroll taxes are the same thing. They're referring to Social Security and Medicare on compensation. The IRS insists that shareholders providing services be paid a reasonable salary for their services, and the IRS is likely to challenge the amount of any salary when it identifies a salary that may be unreasonably low relative to the value of the services provided. So they're going to, if you're trying to dial it back just for those planning opportunities, have trouble getting it down to something that's unreasonable. The IRS and taxpayers have had many court battles over whether salary paid to shareholders is unreasonably low based on the extent and nature of the services the shareholder provides to the S corporation. So this court case, you'll see the citation in the court, case there. Mr. Watson was an employee shareholder in an S corporation, received only $24,000 of annual salary from the S corporation, but received distributions of almost $200,000 per year. So he was an employee and an owner. So he got the employee portion of 24, and he got what was left over this year was $200,000 out of that. At trial, an expert witness for the IRS, because this is how you test what's reasonable or not. You have a battle of expert witnesses. So the government called a witness, and he or she testified that the value of the taxpayer services to the business in this fact pattern was about $91,000 per year. So this was someone who would say, what this person is doing, when I look at the market, that market pays that 91,000 per year. You're only paying 24 for that. So, so the court concluded that any reasonable person in Mr. Watson's position would expect to earn significantly more than what he was being paid in salary, and that his 24,000 salary wasn't enough to support his lifestyle. Okay, so this is when the IRS went in and made an adjustment, increasing the compensation from 24 to 91, and it would have lowered the 200,000 that was left over by delta as well, right? Because it's going to come out of business income and go out as salary. Okay, in these types of cases, the S corporation bears the burden of proving that the compensation paid to the shareholder is reasonable. What is reasonable? What would I have paid if a third party did the same thing that my owner was doing? Right? And this was an owner who was trying to do those planning opportunities that I'm with now. Now, this is a drastic example. What if I went from 90 to 85? Dialed the salary down. Maybe now I'm more in the range. Because an expert's typically going to talk about a range. For as you guys know, if you're interviewing, salaries have, our positions have ranges of salaries. Within a range, transfer pricing people will tell you any point in the range is as good as any other. That's the value of the range, it's not the midpoint. It's the right answer. So you can skew down towards the bottom. That's why when I said those planning opportunities, you have an incentive, but you can't go outside the range. That's what this case is representing. Okay, that's owner compensation. So that's just how do we, if the owner is also providing services, how do we compensate that person? And that differs by business entity. Now, our last topic that we're going to cover in chapter 4 is business entity losses. As we know, not everything makes money every given year. So we could have a bad year just from our own business operations get disrupted, or the economy is having a tough time of it, could cause us to have a loss. So we're going to go by business entity type here as well. So in a C corporation, automatically when I say C corporation, you're going to think separate taxpayer, right? The loss stays in the C corporation. It can't go anywhere. Separate taxpayer, right? So the C corporation, when the tax deductions of a C corporation exceed its income for the year, for the tax year, the excess constitutes what we call a net operating loss, an NOL. Okay? You have lost money in that year. NOLs are of no current benefit to a C corporation. Why? They're separate. It can't offset anything. You lost money. Okay? However, a C corporation can use its NOL to offset income in another year. We have carry back and carry forward rules in the NOL world, just like we had with capital losses and capital gains. We had another instance where we had offsets where we went back. If you're in my international course, we have FTC credits, and we go back and forth, backwards and forwards. Okay, so the rules depend on the year the NOL was created. Just like when we talked about depreciation, and the government always tweaks the depreciation rules to kind of influence taxpayer behavior, they always mess with the rules on NOLs. Okay? The reason being is because they're of no current use. If I lose money in a year, I file a tax return that pays zero tax, but I don't get anything else. I just lost money. No other reduction of taxable income. So the government comes in and says, well, I am here to support my businesses. And I know we file tax returns for each year. And I understand that you might have a year that has a loss. And that's of no current use to you. So I'm going to give you the ability to kind of move that across tax years to get some benefit of that loss. Only in the C Corp world. Okay? So I highlighted here for you because this is the most relevant for you because this is the rule for NOLs because we look at the year of the loss. That law, that year, is going to tell us what we can and cannot do with that loss. So if our loss was created after 2020, 21 and forward, it cannot be carried back. But it can be carried forward indefinitely, which means every year from here to eternity, until they stop and change the law again, it's available to be carried forward but it can only offset 80% of the taxable income in that future year. If I don't get to fully utilize the loss, the excess goes to the next year, and I get 80%. Keeps going until I get that loss down to zero. Okay, so extremely long carry forward period. The government is allowing me to move this current no benefit loss in the current year to future years. Again, I view this as kind of the government trying to deal with the sanctity of the tax year and say, okay, that seems unfair that I tax you in the years you make money and I don't give you any benefit in the years you lose money. I want to kind of have this measured over a multi-year process.
So by offset 80% of taxable income, it means like the amount, it can only, whatever loss you declare in that year can only amount to 80% of the taxable
Yes.
income. The remainder will go to the
Yes,
following year.
yes. So you do pay tax always in that carry forward year because that at least 20% of your taxable income is going to remain.
And do they have to be consecutive? Like if I start one year, start like if it's after 2020 and I don't declare it in this year, it has to be consecutive when I
Yeah,
declare
so I
it?
will use it the first year I have taxable income.
Okay.
I'll start chipping away at it up to 80%.
But I can decide how much when.
You don't get to decide how much.
Oh,
Because
okay.
it will offset 80%
Okay, okay.
of the taxable income. And most taxpayers would want to take it anyway.
You want more
You've been
at once.
losing money and now this saves you from paying tax, as much tax in that year. But
Right.
the purpose of 20% remaining taxable is the government does get some. And this, right, any of these rules we make are in the context of we run deficits. So you can say, well, that seems unfair, then I only get to take reduce 80% of my taxable income. But the government's saying, okay, well, I gotta deal with the budget. Yes.
I wanted to ask about earnings management using the net operating losses. For example, during the coronavirus, let's say there are a lot of industries that do have losses.
Yeah.
Let's say those luxury cruise
Yeah.
companies. What if they use the net losses in just to manage their earnings? Like so, for example, if I have like $10 million loss, can I apportion it when I want in certain periods?
No. I think you have very difficult time in that, right? Because both accounting and tax is gonna be on an annual basis. And so if that loss is in there, so if it's 2020 when the world changed on us in March, right? You're right, cruise companies, nobody went on a cruise, right? It was just stopped and they still had expenses. And so that caused them to run losses. And so what the government did, because they understood that what was happening in the world, is they started changing the rules. And so you see this from 2017 and before 21, and then there was a gap in there where they also had different rules that have since changed. But what they do is they would open up immediate carry back rules so that you could, in the pandemic, you could go back 5, I believe, and file an amended return and get an instant refund. Because the government was trying to get money to businesses. Remember, they didn't want to, don't fire all your people. We're here, we're going to get through this. Keep your people, we're going to make it. If you have a loss, you carry it back and I'll give you a refund for that. And so that's the mechanism that they use to try to alleviate that loss being on an annual by annual basis. So it's really hard to manipulate. It's just going to be January 1 to December 31st for calendars. Okay, the reason I put these other ones down here is because I could have old losses that are still carrying forward, right? I'm a startup and I've been losing money and maybe I got hung up in the pandemic and I was still losing money. We have a lot of losses. My treatment of that loss is in the year the loss is created. And if it's carrying forward, it can be from way back. And so you can see back here, NOLs created before 18, if they're still carrying forward into 26, they can offset 100% of taxable income. Because they were created, the law when it was created, it tells us. Only NOLs created after 20 are limited to 80% of future taxable income. You just have to, you could have different inventories of losses transacting. You see some of these other ones had carried back 5 years, carried back 2 years. Government just constantly tweaks. And it's again to try to provide taxpayer benefit for losses and didn't deal with the budget impact. Okay. So what happens if I have a flow-through entity? Is our sole proprietorship, partnerships, or S corps if I have losses? Now I don't have separate taxpayers. Losses are flowing through to somebody who may have other income, right? I could have individuals who have other income. So owners of flow-through entities can currently deduct losses against their other income, but they're subject to several limitations. We are going to cover in the bubble all these limitations when we get to the specific entities, but just to preview the hurdles we're going to go through, because the government is reluctant to allow losses to offset other income, right? Not disallowing it forever, but they want to have tests before you can do that. I like to think of them as hurdles. You have to clear the first hurdle. You have to clear the second hurdle. You clear a third hurdle. Now, whatever survives of losses after those 3 hurdle jumpings, then you get to deduct against your other income. But you don't even have that opportunity if you do business in a C Corp form. You're separate taxpayer. The only thing you can do is move years within the C Corp under that slide you just went very forward, very back. Okay, so the partners and S corporation shareholders can only deduct losses to the extent of their tax basis in their partnership or S corporation interest. That's the first hurdle, tax basis. Again, we'll cover this in detail when we get there. The second hurdle is what is called at-risk rules, and those are similar to the tax basis rules, except they're a little more expansive. That's why I put them as the second hurdle. Something that clears the first hurdle of tax basis might be trimmed a little bit in the second step on at risk. Okay, and then lastly, passive activity loss rules. This is the third hurdle, and it's there because of tax shelter planning that individuals did in the past, where they like to have a tax plan loss that had been flowing up and offsetting other income, and the government got wind of that and decided to shut that down. So that's our third hurdle, and that's really for passive activities, non-active businesses that you might be involved in that are creating losses. You can imagine why the service would be, the government would be interested in that. You have a business you're not even active in and it's just creating losses and you're using that to offset a bunch of other income. That's the rules we'll go through, the passive activity loss. Okay. And then finally, we have an overall reduction. This one I spike out because it's extremely high. The hurdle is very generous here in how much loss, but it's called excess business loss, which can limit the current amount of deductibility and losses. So what I want you to take away from this is C Corps, losses don't go anywhere except they move laterally amongst the tax years of the C Corporation, depending on the law in effect the year you create the loss. Flow-through losses do flow through, and you use them completely at the owner level. You have to run through the test. And we're going to go through those tests. 411. This is Lucia.
Okay, so assume that Nicole organizes CCS as a C Corp and that in spite of her best efforts as CEO, the company reports a tax loss of $50,000 in the first year. And then her marginal tax rate is 37%, and then the taxable income on her joint tax return is $500,000 in ordinary income before considering the loss. And how much tax will CCS pay, and how much tax will Nicole pay on the $500,000 of other income on the joint return if CCS is organized as a C Corp?
So this question is very indicative of something I could ask you on an exam. It covers lots of different things. Do you understand the differences between the types of businesses and how it relates to the owners and how the overall tax liability is? And you can sprinkle in a loss into that and see how you deal with the losses. Okay.
So because they reported a loss, CCS will pay $0 in taxes, but they can carry over this loss to future years to offset the income. And then,
And so that's just at the, and you gotta be methodical here, right? Deal with the entity, then deal with the owner. Dealing with this example is the C Corp, it had a loss, it cannot use, it doesn't pay any tax in that year, because you only pay tax, 21% has to be multiplied times a positive number. They don't pay any tax, but then we look at the year in which it was created, which is obviously post 2021 in the prior slide. So now it carries forward indefinitely, but it can only eliminate 80% of future tax liability.
and then because this is a C corp, she can't carry over, or she can't use the loss to offset and then her ordinary income, so then we use her marginal tax rate of 37% times her other income of 500,000 to get to her tax limit.
You don't have to do any testing of the loss because it just automatically does not flow through to her. She's the owner, but it's a C Corp, so it stays in the C Corp. Okay? So then she's got $500,000 of other income, she's doing okay, and pays tax at the highest marginal rate of 37. Okay.
And then suppose that CCS is organized as an S corp, and Nicole's stock basis before the 2025 loss is 100,000. How much tax will CCS pay, and how much tax will Nicole pay on her other income? So CCS will still pay $0 in taxes because it's not a taxpaying because it's S corp, so it flows through to Nicole, and then she will pay 166,500 in taxes because she's able to offset the 50,000 of losses because it's a broker entity. Then she'll only have to pay taxes on 450,000 of her marginal tax rate of 37%.
And it's all because of this part right here, right? I get to put the 50,000 on my individual tax return, or Nicole does. And the facts were, she had $100,000 of basis in the S corp. So the $50,000 loss, when we get to that limitation, you can't take a deduction greater than your tax basis. That's the first hurdle. So she clears the first hurdle. Second hurdle, the assumption is she's met that, the at risk, and she passive activity, she's active in this business. So she meets all the hurdles, and so she gets to lodge that 50,000 on her own tax return and monetize that by virtue of paying, instead of 185, she pays 166.5. That's the advantage of the flow through nature in this example of a loss. Okay. Now, if I flip this around and I change just one fact, and this was $50,000 of income, then 50,000 of income would have been taxed at 21%. What would have happened if it was an S corp? $50,000 at 37%. Right? So just good on an income side to have flow through one level of tax, but it's taxed at 37. And then the income side, or the loss side, would have been better because I get to monetize the loss at a higher tax rate. Okay, second part of 411 is Eugene.
What if, suppose CSS organizes an S corporation and Nicole's stock basis before the $50,000 loss is $100,000. Further assume that Nicole does not participate in CSS's business activities. That is, assume she is a passive investor in the business entity. How much tax will Nicole and her spouse pay on the $500,000 on their ordinary income? And the answer is $185,000. This is because Nicole is a passive investor and she's not allowed to deduct the loss allocated to her this year. She has to carry it over and use it in the future years. And this assumes that neither Nicole nor her spouse has income from other investments in which they are passive.
Yeah, so this is just showing that third hurdle, which we'll go through the details of as well. But the benefit of the flow through loss is only if you clear all the hurdles. This is showing she got hung up on the third one. And she pays the full 37% on her full ordinary income. Okay, this chart and the next slides after it is really good. If you want to spend time, it kind of makes your brain work between different topics, the rows, and different in business entities, the columns. And so taxation of entity income, obviously our first thing, the seminal thing here. The entity pays the tax if you're an S corporation, and I get flow-through treatment on the last three. Eligible for QBI deduction, the qualified business income deduction. That is not applicable to C corporations. It is for the other flow-through entities. Okay. Are distributions taxable to owners? Yes. C corporations, dividends. Dividends is gross income, right? No for S corporation and partnerships. S corporation NA, or I'm sorry, sole proprietorship NA, because you don't have distributions. That's right pocket, left pocket now, right? Entity losses we just went through. And losses stay at the entity level. They're deductible at the owner level, but the verbiage there is talking about those limitations. And work through the limitations. See if we get the loss deductible at the owner level. This is stuff we're going to talk about in subsequent chapters, but is the contribution, so when I form these entities or I subsequently put assets in them, is the contribution of appreciated property, assets that are worth more than my basis, and I as an owner put those into my C corporation, my S corporation, my partnership, or sole proprietorship. Can I do that on a non-taxable basis? The answer is yes, but there's going to be requirements on that. We're going to go through each one of those when we dive into each of these legal entities in detail. But as a general matter, I am allowed to move assets in on a non-taxable basis if I meet the requirements. The reason being, the government wants to facilitate business investment. Right? They want entrepreneurs to do things and move assets in. Think about the back end of the lifetime of an entity. Are liquidations taxable? We're going to go through this as well. That depends on your fact pattern and who the owners are when you liquidate. We'll go through that in each one of those chapters. Owner limits here. It's an interesting way to think about this. So this is just the number of owners. So a C corporation needs at least one shareholder. You don't need any more than one, but you need one. That's a wholly owned 100% owner, obviously. It could be 1 million, right? Apple, publicly traded company. I don't know how many shareholders they have, right? But there's unlimited amounts. Just, you're only capped by the number of shares you have. Everybody owns one share. Okay. At the partnership level, we need at least 2. Partnership can't have one owner. Not a partnership. 2 people. You have to be a partner with somebody. But you need at least 2, but you could have a zillion, right? S corporation. This is our most restrictive. I cannot have more than 100 shareholders. This is why it's restrictive in the S corporation. That's just under the terms of the law. I can't make the S election unless I meet this. So they're ranked down here by the authors, and think of this as 1 is the most favorable, i.e. less restrictive, because I can get down to 1 owner for a corporation. Closely by partnerships, but I have to have at least two partners. And then 3, shareholder, S corporation is the most restricted because I have that cap on number of owners, which prevents me from accessing public markets or having a very widely dispersed shareholder. George, you had a question?
So under the S corporation, does it mean owners can still reduce the QBI and then we give the standard deduction as well?
Okay, so that's a great. Yes, I want to say that. So you're doing a good job of pulling forward our individual income tax and layering on a business entity as well. So the individual and the business entity. And so the question was, can I get a qualified business income deduction for the S corporation? That's yes. And the question is, can I also take the standard deduction? The answer is yes on that. So remember, my standard deduction is that I take itemized deductions or standard deductions, and I get to layer on my QBI deduction onto that as well. Yeah. Okay, so that's it on the rest of chapter 4. We talked about just some how does the business entity get taxed, and then today we covered owner comp and deductibility of losses. Yes, sir.
So
chapter 5.
It will cover up until the last class before. And my thought process is there, that'll be in your short-term memory, so you'll be able to access that quickly. So I just want to, just an easier cutoff than something arbitrary.
Will like NOLs survive in like mergers or like, is there like
Great
certain
question.
requirements that be met to?
Yeah, so you have all these attributes for corporations, right? Attributes are like things that are carrying forward or depreciation methods that you're already applying and lives that you're applying. So when you do an M&A transaction and say two companies are combining into one, the question is, how did those attributes come and are they allowed to survive that transaction? And the question is there are tests in order for that to happen. And so what the government doesn't want to do is have you acquire a company solely for their tax attributes, like an NOL. Like if I'm profitable and I like this company, I like two companies as potential acquisition targets, but one has an NOL. I'm like, wow, if I could buy them, use their NOL against my income, and then I won't pay tax for 5 years or whatever, or pay 80% less tax. So that is an opportunity. The government is attuned to that. They don't want you just buying companies for their tax attributes such as NOLs. So there's a mechanism to where they limit the amount of NOL that you can carry forward in that transaction. But yeah, that's an area. I love M&A transactions just because they're cool and sexy and front page of newspapers and Wall Street Journal. But the tax person is a key component of putting the businesses together, and one of the key roles they play is the attributes. You want to try to get attributes to survive because those are worth money. They're literally worth money. They pay less tax in the future. You can keep them. Great question. Okay, so now we are switching, diving straight in headfirst into corporations, and this is the most fruitful part of taxation because I think you're most likely, if you go into this field, you're going to be dealing with corporations. They're either going to hire you to help them do their tax planning, tax returns, M&A transactions, tax planning, all of this stuff is going to be corporations. You might be working for one, you might be working for a firm that is advising a corporation. Corporations have immense complexity. If you just got done with my international course that we had, we're in the deep weeds of multinationals and doing things. And so it's corporate taxation. I equate it to corporate taxation on steroids. Because it's already complicated for a domestic corporation, and now you're making it even more complicated. But again, don't be put off on complexity. This is a lifelong career if you choose to go this direction. Plenty of time to become an expert on this. So we're going to cover in the next few chapters different elements of corporations. This is going to be on the operating corporation. So it's already up and running, making money or making losses, and how do we compute its taxability? Okay. Subsequent chapters, we're going to go through what Jared was saying. We're going to do M&A because we don't just do operations, and hopefully you work or you advise a company. It's going to be doing fun things as well and doing transformative deals. And then we're going to go through liquidations because sometimes corporations cease to exist. How does that work? And then we're going to end with tax accounting, which I teased you about in the past. So hopefully you've had some of that in your other classes, but we're going to go in some great detail on, because it's not just managing the taxable results of a corporation, but they have to find their way into the financial statements, right? Because again, not only will you be working with corporations, I say the vast number of them that you're going to be working with are going to be publicly traded. And they have to be compliant with their tax return, but they're also very focused on what are my financial statements. That's what the CFO is talking about from the analyst community, and what you're measured against with your competitors. So the main thing we're going to be working on here is identifying book tax differences. When I say book, I mean your financial statements, your records, what you're using for accounting. That's going to be our starting point when we go into tax. Okay. we start with something, but we have to identify differences because financial statement rules are different than tax rules, right? Think about our depreciation. We went through some really detailed prescriptive depreciation rules. Those are vastly different than the accounting depreciation. That's a prime area of book tax differences. They're never the same. Two different objectives from financial accounting and tax. So we're going to talk about that in great detail here. So, those of you that took individuals, the computation of taxable income for corporations and individuals is similar in some respects. So you're going to see some things that look similar, but they're different in others, right? Because this is the corporate slice of the pie, not the individual slice of the pie. So the government's addressing these rules differently. Corporations compute gross income in much the same way as other types of business entities and individual taxpayers, right? Why? Power of the pen. They want the government wants gross income to be as wide as possible. They don't make it narrower for any particular taxpayer, right? So gross income is going to be similar. Corporations are allowed to deduct ordinary and necessary business expenses. So we're going to look for that causal connection between why do you incur the expense to generate this income? How do you generate this income? Because I incurred this expense, right? And that's much different than what we did on the individual side. We don't get to deduct all our expenses, right? Your clothing expense, your housing expense, none of that stuff is deductible, right? It's only finite. Remember the itemized deductions? Those are very specific expenses that the government said are deductible in arriving at taxable income. Not this causal connection that you have from a corporation standpoint. Unlike individual taxpayers, corporations do not itemize deductions, nor do they claim a standard deduction. Okay? That is in the individual space. You're talking about standard deductions or itemized expenses, you are talking about individual tax returns. Those do not exist in the corporate world. Corporations, as we just covered, are not eligible to claim the deduction for qualified business income. Why? Because they got, in 2017, they got a reduction in the corporate tax rate from 35 to 21. The QBI mechanic, that rule, was to try to give a similar type tax relief to flow-through entities. So QBI is for flow-through entities, qualified business income deduction for flow-through entities, not available for MSC. Corporations compute their taxable income by starting with financial accounting or book. Again, when I say book or financial accounting, it's the same thing. Okay? Net income, which often represents audited numbers. So there is a base from which to start. I usually have a good starting point of taxable income by using your financial accounting numbers. I don't have that for individuals, right? Bet none of you keep an individual income statement. I come pretty darn close. That's my wife crazy. But we don't have that in the general population, so we have to create that. We have to create gross income, create expenses that belong in there on the individual tax return. Whereas a business already has an income statement. And if it's a publicly traded company, it's already been audited by an accounting firm. So it's a pretty good starting point. Why don't I just jump off from that starting point to start computing taxable income? I.e. start identifying my book tax differences, make adjustments to my accounting numbers to arrive at my taxable income. Go from net income to taxable. Okay. Okay. This is a good chart to compare. This is the corporate tax calculation and the individual income tax. Okay. This kind of goes to some stuff that George was talking about. So I have gross income and deductions. Those are similar in construct at the top. My gross income, what is included is going to be pretty similar between a corporation, a C corporation, and an individual. Where I depart is in the red. I do not have from AGI deductions, and I do not have a standard deduction or itemized deductions in the corporate world. Okay, those do not exist. The whole bottom part of the calculation, once I get to taxable income, I multiply it times the tax rate, of which we only have one in the corporate world. It's 21. I don't have tax brackets. And That's my regular income tax liability. I might have other taxes that get added in there for my total tax, and I pay for that in two mechanisms, credits and prepayments, same as when I'm an individual, credits and prepayments, and that gets me to my taxes due or my refund. So similar in construct, the part that's missing is the itemizing. I do not do standard deductions irrelevant. Instead, my expenses have to relate to my income. Again, why do we start with accounting numbers? Because there's a similar causal connection. You can't have a financial accountant is not going to allow you to do an income statement without the expenses relating to the income and the income relating to the expenses, right? That's kind of the premise of the separate financial statements. So that's why we don't have anything here, is because that already kind of exists. And we have to test it, and then we have to identify just what you're doing for accounting the same as what we're going to do for tax. That's what we're going to spend time on in this chapter. Okay. So first we got tax years. As you know, corporations measure their taxable income over a tax year, which must be the same as their financial accounting year. So again, we want that jumping off part to be static. So we need the same tax years. If we have different tax years, then you're doing two things. You're driving your tax people crazy, and you're driving your accounting people crazy, because people will be very frustrated in this mismatch. So if you're using a calendar year for accounting purposes, you're going to use a calendar year for tax purposes. Using fiscal year, remember fiscal year is the month, end of the month other than December 31st. So you're ending on September 30th. If you're have a year that's October 1 to September 30th for accounting, that's going to be your tax year as well. And that allows you to leverage off of the accounting information. Remember, a tax year can be less than 12 months. First year of operations, nobody really starts on January 1st. You're going to have less than that, so if your calendar, you can be May 2nd to December 31st in your first year, but you can never be greater than 12 months. You cannot slam 14 months into a tax return, only 12 months. Corporation can be calendar, which is the most common, fiscal, which is the next most common, and it can be that weird 52, 53-week year, which is the end of the month closest to the end of the end of a day closest to the end of the month, which can vary by the year you're in. So that's usually retailers will do the 52. And the corporation is taxed separately from its owners. That's why we don't need to look through to the owners to see that consistency requirement. So we can choose what we want for our tax year. Now you can elect off of it if you want. It's just, again, there's a lot of inertia to changing the tax year. Everyone involved in the financial and the tax world is going to be like, no, let's don't do that. But to Jared's point, what if I have an M&A transaction where a calendar year taxpayer acquires a fiscal year taxpayer? They combine and that transaction closes, you gotta pick one. You can't have both going through your systems, right? So somebody's gonna have to adjust. And that's work. That's easy to say, oh, well, we'll just make them calendar. You gotta adjust everything systems-wide to get that all to sync. And again, that's work, and that's what professionals do, is to help businesses do this stuff in a large transaction. Okay, the accounting method. A corporation's choice of accounting method determines when items of income and deduction are recognized for tax purposes. It doesn't determine if, right? So a method just determines what tax year I put that item of income or expense. It doesn't tell me whether I take the deduction or expense. That's a substantive question that I have to look at for each one of those in my book text. Recall when we talked about accounting methods earlier, part of this course, corporations are generally required to use the accrual method. Again, the vast majority of corporations you're going to do, you're going to be involved with are going to be on the accrual method because they're going to be large corporations. You're going to be on the accrual method for tax as well. Remember, we had the exception, you could elect to be on the cash method if you are a small business. That's where I believe your gross receipts over the prior 3 years averaged to $31 million. That's a objective test to determine whether you are, quote, small. And again, the idea is we put you on the cash method, which means you get income when the cash comes in, you get a deduction when the cash goes out. That's simpler than the accrual method, right, for those particular Okay, meat of this check. Identifying book tax differences. Many income and expense items are accounted for differently for book and tax purposes. That is just because they have different objectives, right? What are the purpose of accounting rules? They are to provide information that can be relied upon by stakeholders in making decisions whether to invest or to lend to an organization, right? So they are trying to be conservative with respect to income items and asset treatment, right? Nothing goes on the balance sheet as an asset at a value, or carried on the balance sheet at a value in excess of its fair market value. It's inherent conservatism. You look at it from a tax perspective, what's the purpose of the tax code? It's twofold. It's to get revenue to the government and also to incentivize behavior, right? When we had the depreciation discussions, there were a lot of depreciation rules that are trying to accelerate tangible property investment. If you follow the economic commentary that's out there, a lot of people are looking forward to that as spurring economic activity. That new 100% bonus depreciation that we have this year. So when the numbers start rolling through, the idea is that hopefully that's carrying through. That's not in accounting. Accounting doesn't try to spur activity, right? We're measuring activity. So just by having different objectives, you can expect there to be a multitude of differences between what our starting point is, the book numbers, and where we end up, our tax numbers. So we're going to work through item by item to kind of go through those different line items and try to identify where we might have a book tax difference. Okay, I can't stress this part any more than putting it in bold, and maybe I should have underlined it and put it in red font as well. But understanding and getting comfortable with terminology in this area is key. You have to master the terminology, and that is inherently challenging for young accountants and tax practitioners. This is the start of tax accounting. I think of a tax accountant as the one who is the bridge between the financial statements and the tax information. It's not the person who is just a tax planner might not be a tax accountant because they might not know any of these rules, might not want to touch these rules because they're extremely complicated and fraught with errors. Those that venture into this area are extremely valuable in the marketplace, assuming you're good. If you're bad, you'll be out of the area. If you're good in this area, there's not a lot of people that are. And that's for purposes of the company as well, because the company, it's their financial statements, right? They're required to make these entries. And so they will hire these individuals and pay them well. And then this is an area that audit firms hire people as well, because this is a major issue for auditors, making sure there's no errors in reporting. Errors on tax accounting are one of the highest restatement issues for publicly traded companies. They're usually big numbers. So you got to get this stuff right. So the people that do venture into this, and it's not something that you learn, that you know, and you're in charge of this when you get out of school. Right? This is like you work in these groups and then you learn this stuff over years and years of practice. It took me a long time before I was conversant in this area, but I felt like as a tax planner, I had to help my companies understand how this was going to be recorded in the financial statements because I was working with public companies. I might save them a bunch of money, but when the CFO says, does that drive down my effective tax rate or not? Because I need to get my effective tax rate down. I need to be able to answer that question. That's a great question. So just keep this in mind, it is a very rewarding career. So let's start learning this terminology. First, a permanent difference. So we're looking at, think of our column A on our spreadsheet. Column A is book income, and we're trying to get over to column C, which is taxable income. So I'm dealing with column B. So permanent differences. Those arise in 1 year and never reverse. So something is taxable that is not included in book income, which is weird, or something is included in book income and not taxable income. Same thing for expenses. Is it in book income or is it not in taxable income? Okay, so it's permanent, meaning that it will never reconcile, never equal. Okay, some items the accounting rules just treat differently than the tax rules and vice versa, and they never equal at some point in time in the future. You contrast that with a temporary difference. A temporary difference is sometimes called a timing difference, and they do equal at a certain point in time. Think of depreciation. If you buy a piece of equipment, the starting basis is going to be exactly the same for book and tax. If I purchase an equipment for $1 million, starts off on the books as $1 million. Accounting is going to do straight line over its estimated useful life. Tax, we're going to go into those tables. We're going to do it. But guess what happens? At some point in time, $1 million is fully depreciated for book and tax. That's a temporary difference. Every year it's different, but we're headed towards equally in the future. Okay? And it might start off as one's higher than the other, but for them to equal, then they have to switch. That's when people call that as reversing. The timing difference is reversing, i.e. it's catching back up because you've got to get to the same number in that instance. Okay? So permanent never equals over time. Temporary always equals over time. And you're going to be one of the two. The difference is either timing or permanent. There's no outer space. Okay? Then you have unfavorable and favorable. This is where you need to wear your tax hat, or you'll get these two mixed up. Okay? And people miss this on exams very commonly. We're in a tax class here. If a permanent difference or a timing difference is unfavorable, think of you're advising your corporate client as paying more tax. An unfavorable difference increases taxable income, paying more tax. A favorable difference reduces taxable income, paying less tax. Okay? In practice, people call these good guys and bad guys. You're going to have an inventory of these differences. Good guy, lowering tax, right? We want to pay less tax. Nobody wants to pay more tax. It's a bad guy, it's increasing taxable income. So just be favorable, unfavorable. We're going to be very methodical. We're going to identify differences, and we're going to talk about our permanent or temporary, and where are we in the timing if it is, and what is the treatment relative to book to tax. Is it favorable? Pay less tax? Is it unfavorable, causing me to pay more tax? Okay? And these differences can arise from income or expenses, right? So it could be the top part of the income statement or the bottom part of the income statement, and they can increase or decrease taxable income. Okay? So they don't typically go one direction. So that we're just gonna, don't be hung up on trying to, I'll give you some little tricks that I've learned over time as I go through these things, but just really remember, you gotta have your tax hat on when we're looking at this, when you're talking about favorable. Okay? Understanding and distinguishing between permanent and temporary book tax differences is important for two reasons. First, corporations make adjustments, as we've been talking about, to their financial statement or book net income for permanent and temporary differences to arrive at taxable income. We start with our financial statements. We're making adjustments for permanent items and temporary items because we're getting to taxable income. I have to do that, right? And that I also record or disclose permanent and temporary book tax differences on what is called Schedule M1 or M3. Those are not W models if you're a car enthusiast. They're supplemental schedules to Form 1120. Basically, what they do is that form starts with financial statement income and ends with taxable income. What are they doing? The government is making you show them a roadmap. How did you get from financial statement income to this tax return, taxable income number? And they want to see all those permanent differences, timing differences, and favorable and unfavorable items because they can ask questions about them, right? Especially if you're a publicly traded company, you have audited financial statements. There's been a lot of rigor to the first item, financial statement income. Now you're coming and you're reporting me a different number. I'd like you to walk me through how that number was started here and ended up here. That's not to say that you're doing anything inappropriately, but I want to see that because we both agree we got a pretty good starting point. If you botched your financial statement numbers for a publicly traded company, you got big issues, right? One of them's going to be your tax return is going to be wrong because your starting point's wrong, but you got other issues with regulators and the investing public. But assuming that that's good, then I just need to see the roadmap, and I may ask a question. Well, your depreciation. I see your depreciation is different. Let's talk about why that is. Perfectly reasonable question. You got to pull out your work papers and you show them your depreciation calculation relative to the book. Okay, so that's the first thing you have to do. Is it's tax focused. I have to be compliant with my tax return. That's why I have to identify these differences. The second reason I need to identify these permanent and temporary differences is they are vital to those that are responsible for computing your income tax journal entries for financial accounting purposes. Right? I have to record tax expense in my financial statements. That's not as simple as looking at my tax return and taking taxable income times 21%. Not nearly that simple because of these differences. And so financial accounting is trying to account for these differences because they're, right, financial accountants always make estimates and look at multiple things and arriving at journal entries. So they're looking at, oh, but you got this future depreciation benefit in the future. I want to try to pull that into this year. That's the whole process. And you cannot do your journal entries unless you do this. This is going to be like chapter 7 or 8, maybe 9, I think, where we go through this. We're pulling all this together in the procedure on this. You can't get there unless you have a nice, clean inventory of these things. And you guys have all heard about busy season. These journal entries have to be made in the financial statements in the period in which they end. So, they had a 12/31 calendar year. Month of January is pretty busy because everybody's trying to close the books and publish their financial statements. The income tax entries have to be in there. And so you got to have this nice file, nice organization around all your book tax differences so that you can just go in there. As soon as you get good numbers, you start blasting through that so you can come to your journal entries. You can't be starting from scratch each time. That's when mistakes get made. So, we'll talk about that more. So these are the two reasons. You can't do your tax return, and then you can't do your financial statements.
I feel like there's almost a tug of war between financial accounting and tax accounting, whereas one wants to lower tax and the other one wants to increase. In practice, and I feel like this will probably apply to a public company. Do they sort of act as controls for each other? Like one department, or do they sometimes work in tandem to maybe even cook the books?
I wouldn't say that last part, cook the books, but there is an element of control because one's trying to do one thing and one's trying to do another, right? But they have to talk to each other. And that's where I was saying that role of being the tax accountant is the person who's in the middle. I know enough tax that I can go down the hall and talk to my tax people, but I also know my financial statements and I know those people. So I can work in that space to get this inventory of things and ultimately get the journal entries. So yes, if they're completely antagonistic to each other, that's not going to accomplish the result, right? So if accounting people are sitting there saying, I don't like these tax people coming down in here, I'm busy, I'm trying to close the books, and they keep asking me for information. Yeah, well, understand that you're all working for the same company. So if you're not feeding your information to them appropriately, then they can't do their job, and nobody wants there to be a big problem on these things. So, everybody's under a lot of stress because there's not much time to close books on things. And so you gotta have some cooperation, and you gotta have somebody, it's almost like speaking two different languages. You have some accounting people who will not touch tax, some of you may feel that. But there's plenty of accounting people that don't want to touch tax, there's plenty of tax people who think accountants are doing whatever they want to do, but tax is cool because it's saving money and doing all planning and stuff. But you have to understand that both have to work to each other, or you're not going to accomplish both each objective that you have to do.
Especially in this country, because the tax system in this country is quite complex.
Yes.
Like I did a bit of audit, and I would do tax audit. It was kind of relatively easy because the system there is sort of straightforward, but this is like something else.
Yeah, and it's a great point, because have you guys covered material weaknesses and restatements of financial statements in accounting courses? So the tax accounting process is ripe for having material weaknesses. Material weaknesses means that either you made an error in the financial statements, or even you didn't make an error that was material, but your process of doing so was so chaotic that you just got lucky that you didn't have a problem. Because accounting firms audit firms I should say, do not want their audit clients to have a process that ends up being lucky, right? That's not the goal, right? We got to try to have checks and balances and reviews and processes that get to the right result. And so this is very, very complicated in a short period of time, lots of people working in different things. And so you're exactly right, Claude. The complexity of the U.S. tax code comes to bear here, and it's in fast order. And the other thing that's very interesting here that causes, when we get to the tax accounting, as to why you have errors, the tax return's not even done, right? Remember my example, we just did December 31st of 2025, so January was really busy with closing the books and doing tax journal entries for 25. When is the tax return going to be done for 25? It's going to be in the later summer and fall period. So you have tax people who are making estimates because they haven't done the tax return. But you don't get to wait until the fall to do your journal entries for 2025. So that complexity in a short period of time frame is, nerves get frayed. People get really excited. That's why the people that can really do this stuff just are so vital. Okay, so let's start identifying some differences. So we're going to talk about permanent differences. So these are items that will never reconcile. They can be income, expense, they can be favorable or unfavorable. We're just tumbling through some of these. So interest income from municipal bonds. If those of you that are an individual, you know that municipal bond interest income is not subject to tax for individuals. It's also not subject to tax for corporations. It's relatively rare for a corporation to invest in municipal bonds. It's much more of a individual type investment endeavor. But what happens for accounting purposes if a corporation does own a municipal bond? Interest income is not excluded from accounting income. It's an income. So that is a book tax difference, and it's permanent because the rule for a tax is it's never taxable. So it's in book income. I got to pull it out of book income and arriving at taxable income. So would you think that is favorable or unfavorable? You have that hat on as a tax person. Well, taking income out and arriving at taxable income is good. I'm paying less tax. So that's a favorable permanent item. Okay, so this is the way you have to approach each item. Ask those questions. Is it permanent or temporary? Is it favorable or unfavorable? Okay. A couple others. Meals expenses. So the rule for meals expenses is it's fully deductible for book purposes, but the tax rule is only 50% deductible. So, like this is client entertainment. If you take a client out a customer, say, for your corporation, you take them to dinner, you only get to deduct half of that dinner. There's no such rule in accounting. You're deducting 100% of that meals expense, so long as it relates to the business. Accounting's 50%. Is that permanent or temporary? It's permanent, because you're never gonna get that other 50% deduction. Is it favorable or unfavorable? This guy is unfavorable, because now we're adding back an expense for book purposes that's not deductible for tax. It's gonna cause my taxable income to go up. Okay? So you're seeing how your brain's gotta be rewired to be effective in this area. Entertainment expense. So that's fully deductible for book purposes, assuming it relates to the business, not deductible for tax. An expense item, permanent, because it's never gonna reverse, it's never gonna get caught up to each other. And it is unfavorable because I am taking an expense out of book income, which is gonna drive up my tax bill. Okay. Fines and penalties, political contributions, those are also deductions for accounting purposes, not deductible for tax. They're unfavorable. If I start taking expenses away out of book income, that's not a good thing for my taxable income. Go up, take more tax. Federal income tax is an interesting one, right? When you file your financial statements, you're taking a deduction for all of your expenses, including tax expense. So when you have a number in there for your federal tax expense, that's deductible and arriving at your net income. That is added back when you are computing your taxable income, meaning that it is pulled out, not deductible, because the federal tax computation is not circular, right? If we deducted your tax expense in arriving at your tax expense, then you'd just be doing this in that Excel class and looking at that formula to get that calculation work. So we got to pull tax expense out, and then we compute our taxable income. Okay, I'll leave it at that for today. But again, so we're going to blast through this, just going through book tax differences. Comfortable with favorable, unfavorable. Okay. Sign-in sheet here on the front.
On the, why is it?
Not right
Yeah. Why? Yeah. Why?
but I'm plotting.
I mean, I guess like you're supporting a government or a nonprofit. Yeah.
Myself. I feel like every time I get one, it's just like costing me house.
I've seen local. I've seen local. Not a lot of time. Yeah.
He said that them two is gonna cover things like up until the class before they come,
I'll try to meet you. Or like stand outside or like let you know where I'm at. Or I'm probably not right now. Yeah, you're good.
That would be you.
And I'll pop some eggs real quick.
Like
your own fridge.
Yeah, exactly. Yeah, so something else like that would be pretty big, but that'll be this week's problem.
Yeah.
It seems like every year it would go up. Yeah.
Never listen.
I know we did like a trial run.
No, so we That's why most people, the masters get you there. I didn't see you before. But it's not just that. A certain portion of those 150 accounting. All the CPAs and requirements are state by state. It might be slightly different. Some might require 30 hours of accounting, 7 hours of accounting. It's easy to find, though. There's a website called CPA.
Yeah, we have a video.